that flies in the face of some of these other trends, which are highest credit card rates ever, highest credit card balances ever. I mean, you don't have to look too far to find negativity. The fact that the delinquency rate has doubled in 2 years. But the other side is that debt to income ratio is pretty low. It gets back to sentiment, though. None of this feels good because of inflation. Most people are doing okay, but again, it depends where you are on the spectrum.
Lower gas prices have to be delivering at least some conceptual relief and some actual relief.
Psychologically, yes. I mean, also in terms of expenditures, I think psychologically more than anything. That's one that we just see every day driving around. The fact that wage growth is outpacing inflation now, we want to see more of that. It's really a mixed bag, and it really speaks to that K-shaped economy where some people are doing quite well, others are struggling. I do worry that cracks are starting to emerge in terms of delinquencies, but also, where do we go from here? Do we kind of level off? Or if the job market gets worse, do we see more of a substantial rise in delinquencies?
What usually happens?
Traditionally, the credit card charge-off rate matches the unemployment rate. So we really look to that as a major indicator. Banks don't seem too concerned right now. I mean, it seems that they're still talking about normalization. We've actually gone a little past normal in terms of we've surpassed 2019 levels of delinquency.
Here we go.
Now we're back to more like 2012,
what's up,
which was that
everyone?
Great Recession recovery period.
All right, let's
It
see what's
remains
going to
be seen. I think
happen
banks are
in the
expecting
next
that rate
few
to level
minutes.
off. They're not expecting it to continue to jump, but it bears watching, and I think the job market's a big part of it.
What about the autos piece of this? We mentioned that those borrowing rates are very high, and obviously those prices went up a lot during the pandemic. How does that impact people?
All
So
right, so
auto delinquencies
let's
are
see if we
worse
get
now
a
than during the
spike in
financial crisis.
drop
So I think that's
because
probably
they're
even
going
more of a
to
worry than
raise
credit
rates,
cards right now.
or are we
I think a
going
lot
to
of it speaks to how
spike
much car
and
prices
create
are
a
up.
new
That's been an even
all-time
bigger
highs, or at
factor
least a new
than rates, I would
52-week
say.
high,
Unfortunately,
off
it
of
doesn't
the
seem like a
fact
lot of
that
relief coming there.
they're
So
going to keep the
in
things
many
the
cases,
same.
the option is either stick with what you've got for longer or bite the bullet and pay the higher prices. But that's getting some people into trouble from a financing standpoint.
And what happens next after, if they run into trouble, does the car go away? I mean, what walk us through the chain of events, both on the consumer side and maybe on the financer side?
Yeah, it doesn't take long to see a repossession. I mean, you miss a payment or two. They're much stricter, certainly, than credit cards. Or another aspect of this whole consumer lending thing is the whole buy now, pay later craze. The fact that that was up more than 40% year over year on Black Friday and Cyber Monday, I see that as a warning sign. If we talk about consumers' willingness to spend, but also how are they going to pay for it? I think that's one to watch too.
It's been a great debate. We've spoken with some of the providers who say, it's just a sign of the times. It's actually a better product than credit cards and all that. And then there's others. It's interesting to hear your skepticism about it.
I think it can encourage overspending. Just the fact that it's not $200, it's 4 easy payments of $50. Sometimes that adds up more than people realize and more than lenders realize too, because most of these are not reported on credit reports. I think there needs to be more visibility there. I know the industry's working on it. It's been slow going.
To say the least. But maybe this will encourage them to move in that direction. Ted, for now, we appreciate it. A final thing, what are you listening for most of with the Fed move today?
The market seems to be pricing in something like a full point or even 1.25 points of cuts next year. I think Powell might throw cold water on that. I mean, that seems like a big jump.
Aggressive. And if he does, we know how the reaction will likely go over. Well, we will find out in a few minutes' time. Ted, thanks again. We appreciate it today.
Of course, thanks.
Ted Rossman with Bankrate. Before we go, there's still time to register for tomorrow's CNBC Small Business Playbook. New year, new playbook strategies and opportunities in 2024. To sign up, just scan that QR code on your screen or head over to cnbcevents.com. That does it for us. We're about 7 minutes from the Fed's rate decision.
That's the fundamental at the bottom.
The hour around 2:30 Eastern. Tyler is getting ready. Power Lunch picks up coverage on the other side of this break.
Let's go. Nice little bounce on Meta as well from 332.50 area. Pretty sweet. Let's see what we get. All right, ES is catching a bit so far. We got 4 minutes to go.
You of ownership.
As you probably know, but
Okay,
we'll be looking
right,
for
4
hints
minutes
on
and
when the
counting.
Fed might start cutting interest rates in its text.
And let's get a check on the market heading into that event. You can see tiny increases of less than 0.1% across the board, Dow, S&P, and NASDAQ. And bond yields, meanwhile, are creeping lower, especially after
Let's
that
see
cooler
if we
than
get
expected
a
producer price index this morning.
All right, let's get
spike
right to our
over
all-star panel as we are still minutes
the
away
highs of
from
the
the Fed
day.
decision. Joining us, David Kelly of JP Morgan, Kristen Bitterly of Citi Global Wealth, John Bellows of Western Asset. Ladies and gentlemen, thank you for joining us and welcome. David, let me begin with you. What do you expect the Fed to do, and what do you expect them to say?
Well, I don't expect them to change rates. I think we're done with tightening. I think I don't think the statement will change that much either. I
Okay,
think
levels to
when
look for.
in his press conference, Jay Powell will sort of celebrate better than expected numbers for 2023, but sound cautious on 2024. But I think the really important thing is the dot plot. I suspect that they won't actually move the end of year 2024 number, which would mean, okay, we don't get any further rate hikes, but they only cut once in 2024. And I think that'll be an expression of caution about 2024, an expression that they really do intend to keep rates higher for longer. So I don't necessarily think that's how it's going to turn out, but I think that's going to be the messaging today.
Kristen, how about you? What do you think they will do or say? And why don't you pick up on David's point there about the so-called dot plots and how much the Fed might be inclined to cut in 2024?
I think that's the major question on everyone's mind. This is going to be the third time that the Fed is going to pause. So effectively, everyone knows at this point that they're done in terms of the hiking cycle, and everything is about when are they going to ultimately cut. And this disconnect in what the markets are telling us, where, you know, we have north of 100 basis points of cuts priced in at this moment in 2024 versus what the Fed is anticipating anywhere from 1 to 2 cuts. And so I think it's going to be a game of connecting the dots in terms of the messaging and looking overall, you know, is the market getting a little bit ahead of themselves, both in terms of the number of cuts as well as the timing, because we still have close to a 40% probability that we could see that first rate cut within Q1. So I anticipate Chair Powell is going to, again, point to the data that we're seeing, both in terms of inflation and employment, in terms of maybe walking back some of those expectations.
And John Bellows, do you think he's going to walk those back or not?
You know, I'd like to focus on the core PCE forecast we're going to get today. You know, based on the PPI numbers, Kelly, that you just mentioned, I think that core PCE forecast is going to come down for this year and potentially for next year. You know, in fact, core PCE over the last 6 months is actually running at 2%, or if not a little bit below that. So this is a big deal. You know, we've seen very, very good inflation numbers. I think that's going to be the conversation today.
All
There's a
right,
lot of
30
focus, and
seconds
the
to
other two have
go.
talked about kind of the timing of first cuts. I think the bigger question is, if inflation really is at 2%, why do we need these elevated interest rates at all? And, I think it'll be interesting to hear him address that question today. And I think in some sense, that's more important than the timing, is why do we need these high interest rates at all if inflation, in fact,
I'm
is
already
at 2%
seeing
already?
some
John, do you think
movements.
how much do you think the economy is going to slow
5 seconds
in
to go.
2024,
5
and how
seconds.
will that affect what the Fed does?
I think we had an exceptional
Oh,
summer
spike,
in the
spike.
United States, obviously with that 5% in the third quarter. I think that was the anomaly. I don't think it's right to extrapolate that going forward. I think the moderation that we've seen in November and into
New
December
high.
is more likely going forward. So I think the economy is going to moderate. I think interest rates are high. And we think that'll be a drag. So some moderation, certainly not what we saw over the summer. I don't think that means we have to have a recession, but definitely moderation relative to where we've been.
How about you, David Kelly, on the economy's strength? 20 seconds, please.
Well, I think the economy will slow down to about a 2% pace, but I think the really interesting thing on John's point is I think headline PCE deflator could come very close to 2% in the second quarter, and that's going to put pressure on the Fed to begin cutting at their June meeting.
All right, well, that's very interesting. Let's take a final look before we get the word at the markets there. Basically flat most of the day. No surprises expected here as we get ready for the Fed decision, the release of its statement and the decision. And for that, we go to Steve Leisman.
The Federal Reserve leaving interest rates unchanged at 5.25% to 5.5%, a unanimous decision in the December meeting. The Fed says growth has slowed from the strong third quarter pace, saying inflation has eased over the past year, but remains elevated. It's the first time they said anything positive about inflation for a very long time in the statement. And they backed off somewhat their bias to hike, saying it was now determining the extent of any additional policy firming, inserting the word any into the statement for the first time. They lowered their 2024 Fed funds outlook to 4.6% from 5.1%, so half a point down, forecasting on average for a Fed official 80 basis points of rate cuts next year. It had forecast just 50 basis points from a higher level. Of course, they got rid of the expectation for the forecast for an additional rate hike this year. That's gone. They lowered their inflation outlook for this year to 3.2 from 3.7 for core PCE. That's down by 50 basis points. They hit their 2% inflation target now, maybe a little bit earlier, sort of towards 2025 or the end of 2025. And they see below trend growth of 1.4% next year, a tenth less than the September forecast. Unemployment rate seen at 4.1 next year, about 4/10 higher than the September forecast. And they repeat in the statement that job gains have moderated but remain strong. Now, there's something in the dot plot that I think is worth pointing out. While that median did come down from 5.1 to 4.6, there are 5 Fed officials who are below that 4.6 number who see a full 100 basis points of rate cuts next year, and they're even more dovish into 2025. If you remember the September forecast, there had been at least one Fed official who was above 6%. That's gone, and the top of the dot plot now for next year is now 5.40. So I would say that the Federal Reserve that today took a step towards the market rather than the market taking a step towards the Fed. I wouldn't say it's an all clear on this, but the Fed definitely backing off plans to hike additionally, or making certain that it plans to hike, and also forecasting more in the way of rate cuts next year for the average Fed official than they had in September. Tyler?
And we are seeing, Steve, about the clearest market reaction we've seen to a meeting in some time, with stocks shooting higher. Dow's up about 150 points right now. And the 10-year yield just sank, oh gosh, at least almost 10 basis points. 13, you can see 4.07 is the intraday. On that note, let's get over to Rick Santelli for some reaction here. Rick?
Yes, 415 is where we were right before the number came out. We're at 406, 407. Obviously, we've been down rather aggressively to drop 2-year note yields, getting down to a 453 level. They were around 467, so about 13, 14 basis point drop. I think what is noteworthy here is if you look at the PPI in particular today, there's very little doubt that we see inflation showing. And the new game in town is to, of course, look at the current monthly rates and annualize them over 3 and 6 months. And if you pick the right inflation indicator, maybe the Fed's favorite PCE, yes, you can play with this data and get it very close to the Fed's objective. well, that's all fine and dandy. And I do think that will afford them the ability to come somewhere between the market, 80 basis points, 110 basis points, whatever easing many see. And it is an election year, and it certainly seems to be baked in the cake. The problem is that as we look forward through the windshield with these annualized, very specific inflation metrics, the real issue for Main Street America is the windshield looks optimistic because all the inflation's embedded in the rear view mirror. We have compounded and solidified many of the price increases in the system. Moving forward, that rate of increase might move to zero and afford the Fed the ability to slow it down. But I continue to think of things like the Writers Guild strike, the auto workers up 25% over 4 years, Vegas casino workers first year 11.3% increase, airline pilots 34 to 40% increase. If we look at what's going on with UPS, 170 grand a year with benefits and pay increases. The reason I mention this is those obviously are in the rearview mirror as well, but they have set up a footing of pricing issues that will continue to hurt the market with regard to more workers, of course. And I'm not saying it's a bad thing, but there's going to be ongoing pressure for many others to continue to boost pay. And I think that cycle isn't going to be going away as quickly, even though the Fed will have the ability to lower rates in the future.
Bob Pisani, what would you add as we look at the Dow up 176 points right now?
I think that Steve's right. The Fed has moved towards the market, and that's certainly very good news because the pain trade was down. Remember, we've moved 10% on the S&P since the last Fed meeting. It's moved on expectations that Powell would acknowledge inflation and the effects of lower inflation, that the PCE estimates, for example, would come down, and they would make some acknowledgement that progress on inflation. Look what we've got here. We have a Fed statement talking about slowing, economic activity slowing from being strong, in determining the extent of any additional policy firming. That's a very strong nod to the doves that are out there. And then a nod with the PCE estimates coming down as well. This is about as dovish as you could have possibly expected from anybody. The real concern right now for the markets is just how far it's come. The stock market is overbought on exactly these expectations. The Fed is delivering what the market thinks. The worry now, the concern for the markets is that the inflation data does not come in line with the expectations in the next couple of months. Right now, though, it's about as Goldilocks as it gets.
Bob Pisani, thanks very much. Kristen, I want to come back to you because as you were speaking there before the meeting, I found myself thinking, well, what you're saying sort of sounded to me like the market was expecting more than the Fed has indicated it is likely to do. But as Steve pointed out, now it looks like the Fed has come closer to what the market has been expecting.
That's exactly what I heard as well. So, the question going into this was the Fed going to meet the market or was the market going to meet the Fed? And it looks like the Fed has kind of bridged that gap in terms of meeting the market at least, 3/4 of the way in terms of what was priced based on the dot plot. I think that, some of the things that we're going to look for within the press conference. So obviously these comments about inflation and the first nod to inflation coming down and recognizing that, we've seen that in the data. We know some of the lagging components, when you take out shelter, we're actually at that 2% target in CPI. And so a lot of people are looking through to that underlying data. So the fact that the Fed has acknowledged that, I think the interesting thing that we have to look for within the press conference, though, is given the comment that was just made about how far the market has come, is Chair Powell going to give any commentary about the loosening of financial conditions, just given the market rally and also the movement that we've seen in rates as well, which then kind of brings us full circle in terms of really the timing of this first cut next year?
John, let me turn to you because it appears that in their forecast for the economy next year, the Fed governors as a group are coming to where you are. That is a slowing economy, 1.4%, which is a lot lower than it's been this year.
Yeah, and I think that's especially true on the inflation side, where it sounds like they did downgrade their core PCE forecast. I think it's mostly about inflation here. I think that the tightening or loosening of financial conditions may or may not be appropriate, but as long as inflation is lower, that's what the Fed's going to respond to. The Fed's a bunch of economists. They have an inflation mandate. They're focused on inflation. The news on inflation's been good, and I think they're reflecting that here. And should that continue to be the case, I think they would reflect that through lower rates over time. So I think it's right to focus on inflation. I think that's the takeaway today. And I think that's going to be the takeaway going forward is the improvements on inflation are significant. They're being reflected in the meeting today, and they will continue to be reflected, should they continue through lower rates in the future.
Stocks across the board are up about 0.5%, the 10-year note around 410. And I think someone made the point earlier, Steve Leisman, that falling rates and these kinds of things help ease financial conditions, whereas previously rising rates were tightening them. My question to you is going to be, now that the Fed has moved to where the market is, does the market just keep moving further into pricing in yet more rate cuts or more loosening or more easing of financial conditions next year?
Yeah, Kelly, that's just a bit of cable television
where's the
ESP right there. 'Cause
pullback?
that's exactly what I was going to talk about. That here's what happened. The Fed moved to the market, and the market moved away and further from the Fed. I was actually looking at the probabilities for March, which had been, around 40% probability for a cut. It's now 62%. For May, it's 90 basis points. And I hate to do this live on TV, but yeah, there's the January 2025 contract, which sees 4.05. So there's about 135 basis points of rate cuts built into the futures market. That's the problem. And we may be back to where we were again, where, okay, the Fed is taking a move toward the market's taking a move. The Fed's taking a move towards the market. And now the Fed may have to rein expectations back in. Again, we're going to have to watch the data. The inflation data, John is right, is what's going to determine what happens here. There are good reasons to expect it to come in. But the data actually needs to perform for the Fed to do what the market wants it to do.
David Kelly, your thoughts?
Well, we waited all year for the Fed to pivot, and finally, as a Christmas present, they give us a pivot. But I do believe the inflation numbers are going to be good. I am a little worried that the most dangerous time for the economy is when a tight Fed begins to ease, because those rate cuts aren't just sending a message to the market; they're sending a message to the economy. And a lot of people, if you think there's going to be much lower rates at the end of next year, you really want to borrow money now, you want to wait a while. And I hate it when everybody decides to wait a while. That's very bad for the economy. So good news today, I think, for both the bond market and stock market. But I'm just a little bit more cautious on growth now that the Fed is finally pivoted to an easier position.
That's an interesting point, that it could have a kind of inverse effect. In other words, when you cut rates, that's supposed to stimulate the economy. But when you cut rates, you may be causing people to put on hold their borrowing activity. They might wait because they figure, well, mortgage rates are going to be lower a year from now than they are now. Or a company might wait because they can figure they can get a better price on bonds or better interest rate on bonds a year from now than they do today, David.
Yeah, exactly. Raising rates from very low rates doesn't actually slow the economy, as we've seen many times. And cutting rates from very high levels doesn't actually stimulate the economy. So I think the economy looks okay right now, but I'm a little bit more nervous about it. I feel confident inflation's coming down.
Kill this
but I do
trade.
see that slowdown in growth, and I'm just a little bit more concerned that it could become more extreme as the year goes on. And I think that may be why the market's pricing in more aggressive rate cuts next year.
Bob Pisani?
Sarah was speaking with Janet Yellen this morning, and Yellen made a very, I think, strong case for the soft landing. I think she made very compelling arguments saying, one of the reasons that I'm getting into the soft landing camp, she said, is because in the past, inflation expectations were not well anchored, like in the 1970s.
Okay, so NAS is pulling back pretty decent.
Expectations that inflation was going to be higher for much, much longer. And she made a case saying that is not what is happening here. And that is one of the reasons we don't feel the need that there's going to have to be suddenly high unemployment. She made a case for the soft landing on the idea that inflation expectations from higher for longer for a long time is not going to be happening. She got a little present here from the Fed. I mean, in PCE core 2.4%. It was 2.6. This is for 2024. Fed funds 4.6. That's quite a drop, 0.5% for prior expectations. So the Federal Reserve obviously has some expectations as well that inflation is not going to be some kind of permanent part of the landscape. So Yellen, I'm sure, is quite happy with what she sees here from them.
Rick Santelli, if you were to give a grade to the Fed and its statement here, what would it be?
Well, I think so far I would probably give it a B- or a C+. The problem I see is X food, X energy. Now many of the guests on CNBC are saying X shelter. So basically, X inflation, we have very little inflation. I think that when you consider the idea that over the next couple of years we have a rollover of debt the interest rate that we pay to service the debt's going to take a big jump at about that same time period, that I think this is the big end of the world party, that the Fed's raising rate cycle is over. I don't have a problem with that. But to think that the market rates, especially in the long end, don't have a possibility to be moving up after we get through the election next year and have to reckon with some of the big issues we have on servicing the debt in the budget, believe me, we should enjoy the fact that we're putting some cushion in markets like the equities, because there's going to be some tougher sledding in about 3 quarters from today.
I guess that leaves us with the question, and Kristen, I'll direct it to you. What are you going to hope to hear or not hear from the Fed chair when he begins speaking?
So I think we just have to bring all of this together in terms of remembering that while he did give a nod in the statement to inflation, he also pointed to the strong labor market as well. And so we have to look at these two things. And I'm going to bring this all back to the fact that, yes, the inflation data is going in the right direction, but there is the potential for the market to get a little bit ahead of itself in terms of when we anticipate seeing those rate cuts. And I think most of what we've heard today is this idea that we're not expecting that a soft landing is possible. We're not anticipating a recession, but we are expecting a slowing of growth. And so that's going to ultimately show up in the data, and particularly in employment. And that would be the signal to the Fed to ultimately start cutting rates. So I'm going to look to those signals overall in terms of that balance between their dual mandate of, yes, inflation is going in the right direction, but let's talk about the labor market as well, which should give us more signals as to what we should be pricing in for next year.
All right, Kristen, thank you very much. And thanks to our entire panel, John, David, Steve, Rick, Bob, everybody. And we will be watching throughout the rest of the afternoon to see what the Fed chair says. We'll obviously see Steve in the room. We're just minutes away from Jerome Powell's press conference. We will take you there, as I mentioned, as soon as it happens. And Steve Leisman will be in the front row. But first, we will get more reaction to the Fed's latest decision after the break. So we'll be right back. Stay with us.
Took the loss. I'll wait. That's it. I'm gonna call it a day. I'll see you guys tomorrow.